Welcome, friends. Welcome to our new episode on Money Talks. Last time, we spoke about the importance of investments at a very early age. The earlier you start, the better are your prospects of creating great wealth in the future. Better are the prospects of protecting your principal and maximizing and multiplying your investments manyfold. The simple rule that works when you start early are averaging and compounding. Your investments, as they grow ripe or as they keep growing over a period of time, they will start growing at a fantastic rate. And that's why you earlier you start, better it is. Last time we looked at the basics of investing, some principles. One important aspect that we touched upon was risk. High risk is equal to high returns, and similarly, low risk, if you're a conservative investor, a low risk would mean low return. That risk factor is very important when you are talking about investments. If you put all your money into one asset class, say equity, in times of extreme volatility or in times of extreme uncertainty, your investments may get eroded, the value may get eroded. Equity, as everybody knows, as we all know, it is one of the highest asset class with the highest risk. If you put your money in maybe a bank deposit, you would earn very less interest, which may not fulfill even the inflation. So, it is very important that you diversify your investments in such a way that your risk is minimized and your returns are maximized or optimized. So, optimal returns and optimal risk. You need to understand how to do that. That process is called as diversification. So, the topic for today's discussion actually is diversification. So, what is diversification? It is spreading your investments across different asset classes. It is a practice of spreading in investments across different asset classes to reduce the risk or to minimize the risk. So, by investing in a variety of assets like equity, debt funds, mutual funds, real estate funds, investors can minimize the impact of any one single investment's performance on their overall portfolio. So, your portfolios should be such that you would have different asset classes with different risk profiles, which will help you in minimizing or mitigating the risk associated with exposure to one or two asset classes. Diversification helps against volatility. It protects your money against volatility and also can enhance long term returns. As the saying goes, don't keep all your eggs in the same basket. Diversification aims to do exactly that. Do not put all your money into one asset class alone, because a significant impact on one asset class will lead your investment to move to zero, or there would be significant impact on your investments not giving you enough returns because of the risk associated. Many a times people fail to understand, when we talk about high risk is equal to high return, that also means that high risk can lead to significantly higher losses as well. So higher the risk, higher the returns, or higher the losses as well. So diversification will help you in protecting your money from getting eroded, principal from getting eroded due to market volatility or variations. The benefit of diversification, it helps reduce the risk associated with any one investment. If one asset performs poorly, others may compensate, thereby minimizing the losses or maximizing the returns. The enhancement of returns by diversification. Investors can potentially benefit from growth and success of different assets, capturing gains and optimizing returns. Capturing gains and optimizing returns. So You will have multiple portfolios over a period of time. All the portfolios may start working in tandem with each other, minimizing the risk associated with other classes, but they all together will also perform or start performing even better. Preservation of capital. The most important aspect of any investment is preservation of capital. I'm okay if I don't get great returns, but I should at least not lose my investment. So preservation of capital is of utmost importance. Diversification acts as a safeguard, preventing significant losses in case of adverse events or market downturns. We have seen this happening many a times, investors losing money when they are exposed too much to equity markets, for example, or maybe to the real estate markets. The 2008-9 subprime crisis was a great lesson to everybody who had invested heavily into real estate or even equity markets. One single incident eroded the entire wealth of several investors. Many went bankrupt. Many had to lose their hard earned money saved for their retirement, losing everything in that one market uh, event. So, by diversification of your investments, you will at least be able to preserve your capital to a reasonably good extent in the case of market downturns or any adverse events. The types of diversification. There are multiple ways in which you can diversify your investments. Let us look at one at a time. So the first is the asset class diversification. You can diversify your investments by investing across different types of assets such as stocks, bonds, real estate, or commodities maybe. So by diversifying across these classes, investors can spread the risk and potentially benefit from various sources of returns. So when we are actually putting our money into multiple classes of assets, we are actually creating pillars of income generation. Each pillar that you invest in, maybe equity, maybe mutual fund, maybe real estate or commodities or any other investment asset class, you are actually creating future income generating opportunities. So, by diversifying across asset classes, investors can spread risk. So, creating pillars for income generation and also minimize or spread the risk across multiple asset classes and potentially benefit from various sources of return. So, you will also be benefiting from multiple sources of returns. Asset classes have different risk return characteristics, allowing investors to balance their portfolio based on their goals and risk tolerance. So you can always balance, rebalance, evaluate your portfolio. Maybe at some point of time you have 50 or 30 or 40% exposure to equity, 20% exposure to mutual fund, and 30% to commodities and real estate, etc. You can keep reevaluating the portfolio, the risk appetite, the goals that you have. Accordingly you can rebalance the asset classes. The second type of diversification is geographic diversification. It means that investing in assets from different regions or different countries. Okay, it means investing in assets from different regions or different countries. This strategy is effectively used by many foreign institutional investors or foreign investors. Uh, in one country, they have plateaued as far as their returns are concerned. So how do they maximize their returns? If their geography is at most giving 6, 7, 8%, 9%, 10% returns, whatever the number may be, how do they go beyond that 10%? So the one single way or simple way of doing that would be investing in countries which are growing faster than the home country, right? So this strategy helps reduce exposure to country specific risk and takes advantage of growth opportunities in various global markets. So there are two parts of it of this. One part is if there is high risk in the home country, uh, maybe a war, maybe civil unrest, maybe recession, or maybe whatever. I mean, there could be political unrest. The risk of investing in that country or investing in the asset classes in that country would be very high. In that scenario, investors would be looking for different avenues to protect their principle, conserve their principle, and also maybe earn better than what their country is able to offer. So this strategy helps reduce exposure to country specific risk and takes advantage of global opportunities in various global markets. As we talk today, there is so much of unrest going on across several parts of the globe. Talk about the Russia Ukraine conflict, talk about the Middle East crisis, talk about crisis here in India and China, talk about the problems that are happening in Pakistan and neighboring countries, talk about what was happening a couple of days ago, a couple of months ago in Sri Lanka, almost on the verge of bankruptcy. So there are so many geopolitical aspects that will actually influence investment strategies, depending on the safety, depending on the geopolitical considerations, depending on the return profiles, depending on the risk profiles, so on and so forth. So investors, especially foreign investors, would generally park their money into different asset classes across different countries. Global diversification can provide access to different economic cycles, currencies, and industries, improving risk adjusted returns. So, this is geographic diversification. The third type is sector diversification. Sector diversification, it involves maybe investing in different industry sectors, such as maybe in technology or in healthcare, finance, consumer goods, industrials, so on and so forth. So within the same economy, maybe you can put some money into healthcare, pharma companies, for example, some in technology. Now the AI stuff is booming right now. As technology transition keeps happening, there would be a lot of focus on technology companies. Thereby, a lot of investment will start flowing because that sector would be considered as a high return sector, potentially high return sector. So people will start moving into technology sectors whenever there is this transition happening. So when Google came into existence, now with AI happening, there are a lot of focus on the AI, on the technology firms. uh, Healthcare, I mean, after the global pandemic, the corona pandemic, healthcare care has gained so much of importance, and there is so much of development that is happening in healthcare. um, that would be another sector. Finance could be another sector. Spending, consumption, as the consumption keeps on growing, as the consumption or as the infrastructure is being built, you will need finance for all those things. So finance, if eventually will start growing, the finance sector will start growing. Consumer goods, if economies are good, then there is good consumption happening. Automobiles, staples, so on and so forth. So there are several sectors within one economy, and you can diversify your risk by putting in money into maybe a few companies or from healthcare, few companies from technology, few from finance, and so on. So sector diversification helps spread risk by avoiding over concentration in a single sector, and captures growth opportunities across different industries. Note sector. No, I mean, you should note that sectors can perform differently based on economic conditions, regulations, and consumer trends. Market making diversification even all the more crucial. So during, if we talk about the Indian ecosystem, so during the monsoons, just before monsoon, if the monsoon is considered to be good, the fertilizer companies, for example, start becoming very attractive. Their valuations become very attractive. There is a lot of investment that will be made in those companies, because the consumption of those fertilizers will start sometime around early monsoons, beginning of monsoons or during the monsoons. So fertilizer sectors will start. The tractor manufacturing companies will start gaining momentum. So those kind of things also. If you talk the festive season, when the season starts, there is a lot of impetus on the uh, uh, consumables, on automobiles. uh, all these sectors will start booming during the festive seasons. So sectors can perform differently based on economic conditions, regulations, consumer trends, and that is why diversification is so crucial. Let us look at what are the strategies to implement the diversification strategies. The first and the foremost thing that you need to determine is the risk tolerance. Assess what is your risk appetite, or how much risk are you willing to take, your risk tolerance. So that will guide the asset allocation decisions and also ensure diversification aligns with your comfort zone. Don't uh, the risk tolerance actually is best tested when it is when the times are very stressful, when the market is going down, when nothing is happening in your favor. Are you willing to take that risk, or are you willing to take wait for the market to turn around, to that for that event to pass? If that is the case, then take your risk accordingly. Determine that how much downfall am I able to withstand in the market. So that is risk tolerance. Asset allocation. So after you have determined your risk tolerance, allocate your investments across different asset classes, considering their risk profiles and potential returns. And if you have $100 in your pocket and you want to invest all that $100, the first thing that you should do is only invest $50 into different asset class. Keep that balance $50 or $30 or $20, whatever you want to save for the rainy day. Put it when the market is in favor of investments, not what when the market is booming. In fact, as Warren Buffett says, that when there is blood on the street, you should make a grand entry, and when everybody is greedy, you should make a quick exit. Okay, so keep that 20 $30 that you have, or 20 30% of your assets in cash, so that you would be able to take the benefit of opportunities when they come knocking your door. Rebalancing, very important thing that you need to do regularly. You should keep reviewing and rebalancing your portfolio. Always take money off the table. If a particular investment or asset class is giving you good returns, it's better to take some money off the table, so that you keep taking profits at regular intervals. Not that you should keep doing it very regularly, but at least keep it doing, so that you can use the same money again when the market is down, or when there are better opportunities to put the money back into the market. So regularly review and rebalance your portfolio to maintain the desired asset allocation and diversification level. Consider diversified funds. So there are now many funds that are available in the market: mutual funds, ETFs, index funds, uh, where you can put your money into those funds. So those funds actually uh, will be a representation of the entire market volatility. So you don't have to really worry about uh, putting in your money uh, into individual asset classes, like, or into individual companies. Here you can use mutual funds or ETFs, where they automatically take care of the risk aspects. Index funds also. What are the mistakes that you need to avoid in diversification? Very important aspect of diversification: don't keep all your eggs in the same basket. Having said that, you should not keep your eggs in so many baskets that you are not able to manage it. Okay, that is also one aspect. So overspreading of your investments may not lead to good results. So that is called as over diversification. So spreading investments too thin can lead to diluted returns and making it challenging to monitor and manage the portfolio effectively. So typically, your optimal portfolio, I mean, if you have $100, you should not have more than maybe 10% in a single asset class, and you should not have less than 5% in a particular asset class. So that should be the range. So you should have about 8 to 10 asset classes, or uh, companies in your portfolio. It becomes easier for you to manage. It becomes a good diversification strategy, and you will be able to protect your principles also. If you have done that in multiple asset classes, you will not be able to monitor it, or it will be very time consuming to monitor those overly diversified portfolios. And again, the returns on such overly diversified portfolio will it's almost would be as good as no great returns. So do not get into that over diversification mode. Keep it optimal. false diversification. So you have to be very cautious of investing in assets that are highly correlated, as it may not provide true diversification. For example, you are in an automobile company, automobile sector, for example. You have invested in one automobile company, and the second asset class also happens to be an automobile company, maybe a directly or auto component company, for example. So which may not be a great way of diversifying, because both these companies may be related to each other. If one company or one asset sector, automobile, goes down, eventually the auto component sector also is going to go down. So that correlation, I mean, that would be treated as a false diversification. You need to ensure that your diversification is properly done. For example, if you are putting your money in auto sector, maybe you should put some money in the finance sector, or maybe in pharma industry. So that will not be correlated, and one asset class will mitigate the risk of, or compensate the higher risk of the other asset class. So that is one thing. So do not get into that false diversification mode. Neglecting portfolio reviews many a times, and many, if you are typically, if you are a long term investor, you put your money, shut it, fill it, forget it. I think that's not what works in the real investment world. You should keep reviewing your portfolio regularly. You should keep looking at the different components of your portfolio, or different asset classes in your portfolio, very regularly. Rebalance them, look out what is working and what is not working. Again, it's a process of experimentation also, but that experimentation should not be very costly. You should make sure that your experimentation is properly well advised, well learned, or well researched. Okay. So regularly review and monitor your portfolio to ensure it remains aligned with your goals and risk tolerance. Mm, just to give you some examples about diversification, for example, we have Sunil as a young investor with a long term investment horizon, and he understands the importance of diversification and decides to allocate his investment portfolio across different asset classes. Um, so he would typically, I mean, a typical example, Sunil would put his investments in stocks, bonds, real estate investment, trust, that is rights. So this diversification will allow him to balance potential high return stocks with the stability and income from bonds and rights. Rights and bonds income from bonds, they would be reasonably safe, secure, maybe low returns, but very safe investment class. So by diversification, Sunil would reduce his overall risk in his portfolio while still having the potential for great growth. Geographic diversification. What is the importance of um, geographic diversification? So, for example, Mark is an investor who learns about the benefits of geographic diversification. He previously had all his investments maybe in just one country, his stock market. Now, with the global uh, markets being accessible to anybody and everybody across the globe, Mark decides to expand his portfolio by investing in international markets, specifically in emerging markets with high growth potential, mostly India, or maybe China, Philippines. The Middle East is growing, the African nations are growing. High growth potential, they are in the stage of development. So these markets have high growth potential. So Mark researches and selects a mix of exchange traded funds. So there's a new instrument that is available, ETFs as they are called, that offer exposure to various global markets. So sitting over here in India, for example, I can put my investments in, or I can buy ETFs from of the US market, for example, or some other European markets. So this diversification will allow Mark to reduce the risk associated with being overly dependent on a single market, and opens up opportunities for potential growth in other regions as well. So he gets the best of both the worlds. Um, Sectoral diversification. Again, how do you do sectoral diversification? A student maybe starts investing in individual stocks, but notices that the portfolio is heavily concentrated in technology sector, for example. Uh, so the student Anil realizes the importance of sectoral diversification and then decides to broaden his investments across the different sectors such as healthcare, consumer goods, and finance. So by diversifying his portfolio, Anil reduces the impact of sector specific risks such as regulatory changes or technological disruptions and increases his exposure to different growth stories or emerging growth stories of the economy. Uh, the benefits of regular rebalancing is also very vital. So, whenever uh, you need to review your portfolio periodically and make adjustments, act on the aspects that you feel are working or not working, and bring it back to the desired asset allocation. So, if your asset allocation is uh, n- you need to refine and redefine the asset allocation by rebalancing. So this is in a nutshell about diversification. Uh, you should, as in the last topic, as we mentioned that you should start investing at an early stage, and you will start learning the lessons also at an early stage. One of the most important assets lessons that you would learn during your investment journey is the relationship between risk and return, and return and diversification, or risk and diversification, are also very closely related. Start learning and start earning these aspects this start learning these aspects at a you have to start making investments to learn all these things. And the earlier you start doing the investment or diversification of your investments, you will be in a better position, or you will be able to experience better growth and great wealth creation. So this is so let's wrap up the discussion on diversification, the importance of spreading your investments across different assets. But diversification is the key strategy for managing risk and maximizing long-term returns in your investment portfolio. So by diversifying across asset classes, geographies, and sectors, you can reduce the impact of any one investment's performance on your overall portfolio. It helps to protect your capital, enhance returns, and create a well-rounded investment strategy. Remember, diversification is not a one-time task, but an ongoing process. Regularly review and rebalance your portfolio to ensure that it remains aligned with your goals and your risk tolerance. Stay informed about the market trends. Keep your eyes and ears open. Seek expert advice when needed. So, as you continue your journey as investors, keep in mind the valuable lessons we discussed today. Explore different asset classes, research international markets, and consider sector diversification. So, by implementing these strategies, you can build a resilient and a diversified portfolio that can weather the market fluctuations and work towards achieving your financial goals. Thank you, friends, for joining us on this episode of Money Talks. It was a great pleasure talking about diversification today. Be sure to tune in the next time as we delve into another exciting topic in personal finance. Remember, when it comes to your money, every decision you make matters. Stay curious, stay informed, and make smart financial choices. Until next time, thank you very much. Ciao.